Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Paul Sweeney, along with Tom Keene. Join us each day for insight from the best in economics, geopolitics, finance, and investment. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show. Weekday mornings from 7 to 10 Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And as always, on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. All right, let's go to a pro here. Quincy Krosby, Chief Global Strategist at LPL Financial. Quincy, thank you so much for joining us here. What do you make of what transpired from the close on Thursday to where we are here?
Well, you could attribute it to the unemployment number jumping. It skipped 4.2, went right to 4.3. Expectations were that it would remain at 4.1. And there have been concerns. Even Powell mentioned it at the press conference that they are, I don't know if he used the word monitoring, but it was close to that, the employment landscape. He has been invoking the maximum employment mandate over and over again over the last, month or 2 months. And now he's got a situation in which the market believes that the push in the unemployment rate, which in and of itself isn't, but he even talked about 4.1, was still a resilient labor market. Well, we jump up to 4.3. The question is this the harbinger of a labor market that is going to weaken at a faster clip? Because that's what the historical pattern suggests, that once you start moving up higher, it continues to move up higher. The other thing were the initial unemployment claims and also the continuing claims. And that is worrisome because you can argue about the participation rate, all of that. But when you see that people cannot get jobs, it's harder and harder for them to get jobs. You have to look at this employment landscape and wonder, is there something deeper going on? And you don't have to be a PhD economist to figure it out. Yes, there is. Companies may not be linked right. So therefore, you had that. And that was, by the way, in conjunction with the ISM manufacturing report that has been deteriorating even at a faster clip. Today, we'll have a bigger picture on the services. Yeah,
we get those ISM services at 10 o'clock, which I love that indicator as well. It didn't take Wall Street banks a lot to jump on this. I mean, within hours, we got JP Morgan, we have Citi looking at 50 basis point cuts for September and November, and then 25 basis point cut in December. Other banks sort of added on to that. Are those kind of calls justified?
They'll only be justified if the numbers continue to deteriorate. The market has wanted, as you know, what was it, 7 rate cuts this year? They're lucky. And then they thought, maybe we'll get one in September. But the fact of the matter is that finally they have an economic rationale for suggesting that the Fed has got to come in and offer more help. And the Fed is going to have to do it. The worry is, and I don't mean to be looking at what they did wrong at the beginning. They waited too long to raise rates, and then they are looking as if they're behind the curve already.
Emergency rate cuts. Put that into context. When do they happen? Why do they happen? Should emergency rate cut be on the table?
Well, it should always be on the table, and it is always on the table because the Fed could come in at any time to raise rates or cut rates. And I think if they do see that the unemployment rate is going to rise again, if we start to see a host of data releases that suggest even more deterioration, such as what we're going to have this morning with the ISM service sector report, they may have to do that. They don't want to do that. There's always this suggestion. Now, this is what's ironic, that it'll scare the market. Well, take a look at the market today. Yep. Take a look at it on Friday. The market is already scared. They're not going to cave unless they really believe that they are behind the curve. And the other thing is there are rumors that at the last Fed meeting, there were those who suggested that they needed to cut rates at that meeting. The Fed is waiting an awfully long time until September 18th. The market is clearly not waiting that long.
So that brings the question into the actual market action. If you look at the S&P futures, we're down by 3%. NASDAQ futures off by over 4%. I mean, it's ugly, right? And this raises the question of selling begets selling. Like, once you trigger stops, then you have to sell more. You have a systemic funds that'll come in at 9:30 when the cash market opens, and they're going to have to be selling more, like CTAs. You have the yen carry trade unwinding. How much of that is playing in versus the fundamentals?
Well, that, this is the basic argument, because you can make an argument on both sides of the equation right now. The labor market, with the numbers that we have, suggests that there is still some resilience. The fact that the GDP report for the second quarter, the first read, came in at 2.8%. The fact that consumers continue to spend. But the question is, the market is looking ahead. That's the market's job. And by the way, I should point out that the economists at the Fed should also be looking ahead, because that's an economist's job as well. And then the concern is that, again, selling begets selling, buying begets buying. That's the way it is. Margin calls are coming in. It creates a vortex of the VIX climbing higher. We haven't seen the VIX climb this higher in a long time. But the fact of the matter is, the Fed is going to be very careful about coming in and suggesting that we need an emergency move. However, I do want to point this out. I will never forget a Christmas Eve on 2018, as that market just tanked, and the Fed, that December meeting, raised rates, suggested we would have rate hikes in 2019. The first Friday in January, the Fed called it off. Remember that, before the market opened, right? Fed's going to be patient.
Very
End
good.
of story.
All right, Quincy, fantastic perspective. Thank you so much for joining us. Quincy Krosby, she's the Chief Global Strategist for LPL Financial. Boy, the economic narrative really seemed to pivot on Friday with that weaker than expected jobs data, really calling into question the health of the U.S. economy and of the U.S. consumers. Let's get some color on that right now. We can do that with Anjee Solanki, National Director of Retail Services for the U.S. at Colliers. Anjee, thanks so much for joining us here. What's your view, Anjee, of kind of the U.S. consumer right now?
It's really interesting when we look at the U.S. consumer. I mean, we've actually seen a slight, gain compared to June 24 to 23 by 2.3%. Although from prior month, it's been relatively unchanged. Now, we're forecasting a 2% at year end. And we're trying to kind of wrap our hands, around what's going on with the consumer. Paul, I'll just let you know, we're really seeing the consumer having so much convenience and ease of shopping with online or in store. I mean, it's really a frictionless type of shopping experience. So they're spending more.
All right. So I'm not into this back to school thing because my kids are grown, but my youngest, he's going to be starting a sophomore year in college, and we bought him his first suit yesterday. So that is my back to school shopping scenario. But Anjee, I know it's a thing for the retail space, back to school. How's that looking so far?
It's looking actually quite well. We've actually seen an early start to back to school. So right now it's about 8% up compared to what we've seen in the past. And I think people are refreshing their closets, just like your son with his suit. I mean, people are taking pride in what they're wearing.
Do you feel like we're going to see a value war, though, for back to school, similar to, say, fast food chains like McDonald's, Burger King, Wendy's? It's all about that value, right? How's that transmitting itself into the retail space?
Definitely, you're still seeing value. Look, there's still a discrepancy as it relates to wage and job growth and unemployment. So people are still managing their funds. They're being conscientious. They're taking their time and understanding how much to buy, where to buy, and how much time they're spending. So there is a value-driven component, but there still is that middle class and higher income, where they're still spending and not thinking too much about it, so there is still that hyper spend occurring.
How about some at the lower end? I'm thinking some of the dollar stores. How do they fare in this environment where, again, we really see a disparity in income and a disparity in retail spending, savings rates, credit card delinquencies? How are the dollar stores kind of seeing business today?
I think they're actually going to do quite well, with some changes that we've seen with 99-cent store closing. There's still a need, and therefore you're going to see them actually kind of rechange their merchandise and their product mix in their stores. So with that, there will be an increase in terms of the people going into that store spending, because at this point, with 99-cent no longer around, people have nowhere to go other than they're going to maybe shop in the Targets and Walmarts. But that 99-cent store and that dollar store is still bringing value. So you're still able to buy produce. You're still able to get, quick, grab and go items, batteries, household goods, napkins, etc. So I think there's still definitely going to be an increased foot traffic in those types of value stores.
What would you be telling, what area of retail has the most problems, and how would you tell them to solve that problem right now?
When you look at retail overall, the grocery sector has been pretty steady. And what I really have noticed in terms of the grocery spend is that it's been seen in actually a very, slight increase, about 1.7%. And so when you stop and think about that, it has to do with the cost of the product and the goods within the stores. Also, I think if you stop and think about it, you can go into a quick serve. Yes, it's a little more expensive in terms of, the per person spend. But if you look at that versus, grocery, cooking at home, making your meals, doing the dishes, all of that, it might be a little more convenient. So, the quick serve restaurants, the fast food restaurants, although seeing a bit of a slowdown, it's still, they're still seeing quite a bit of pace. We're actually, from a retail perspective, in terms of leasing, we're actually seeing more quick service restaurants looking for space, looking to expand. So it hasn't slowed down in that part, but I would say groceries still trying to figure itself out.
How about luxury? We've seen some of the luxury retailers report some sluggish results of the most recent quarter, citing in part, the sluggish Chinese economy and lack really of outward bound travel by Chinese. How's the luxury space look to you?
It has slowed down. I would say that it's slowed down if you're comparing it to kind of the peak we had, during COVID and slightly after that. I wouldn't say it's completely, it's less than 2019. It's still, ramping. It's still in, I would say, maybe 15 to 20% from 2019. So we are seeing a slowdown. There definitely has been a slowdown as it relates to just the overseas. I think people are still looking at luxury. They've kind of spent during the last few years and have, kind of identified and purchased what they needed. So we are seeing a bit of that occurring at the moment. And also I think we're seeing, kind of that Chinese Asian consumer going elsewhere to spend in luxury, maybe not in the US.
That's interesting. Yeah, exactly. Like Chinese going to Japan, I think, because of that exchange rate. You have to wonder what happens after the last couple of days. But I want to I know this might be a little off field for a second, but in terms of EVs, we've had a lot of the car makers report, and it's been really ugly out there, particularly when it comes to sales, whether in China or in Europe, when it comes to EVs. However, can retailers, though, capitalize on this shift that we are eventually going to see?
I would say yes, for a couple of reasons. So what was really interesting when we started digging into these numbers was when we saw that foot traffic, so the actual footfall in stores was starting to, drop. We started to dig why. Why is this happening? This is really for your large major, retailers, big box retailers. Well, because they made it so easy to shop online, pick up in store, curbside pickup, etc., they started to notice that people were not spending as much time in the store. So by putting or getting involved in that kind of retail or EV sector, you're really creating another reason for that consumer to come into the store and spend more time. So it's not a 15-minute in and out, but if I'm charging my car, if you have an EV car or vehicle, you can actually go in and you're going to, you may start buying things that you didn't even think about. So you're spending 30 minutes, 45 minutes, or even an hour in a store, you're going to be accumulating just things to purchase. So I think it's a little bit of that. Plus, it could be another additional revenue channel. They may be able to advertise specials, if you're sitting in your car, charging your car and waiting, you might see something that pops up that's going to drive you into the store to make a purchase.
Anjee, thanks so much for joining us. Always appreciate getting your thoughts on the retail side of the business. Anjee Solanki, National Director of Retail Services for the United States for Colliers. Melissa Otto joins us here, head of TMT Research, S&P Global Visible Alpha. Melissa, we were just hearing Lisa Mateo rattle off some of these pre-market trading numbers for some of these big tech names like Apple, like NVIDIA. Are these entry points? I think if you had told somebody, Thursday afternoon, hey, I can give you NVIDIA 30% off its recent highs, I think most of the people in the market would jump at that opportunity. Well, you have that opportunity here pre-market. What do you think about some of these big tech names, Melissa?
Good morning. Thank you. It's a wild one on this Monday morning. It's all about expectations. And NVIDIA is certainly a company that has very high expectations. So it's critical to believe in the direction of that company and where it's going. And the Blackwell series is expected over the next couple of years to generate sales of over $100 billion. So ultimately, the company has to deliver on those fundamentals for the expectations to meet where they are.
So does that mean that if we have reports, there were reports that NVIDIA had some production delays? Okay, if they can't produce the stuff, even if the demand is there, they can't book the revenue. So could part of the sell-off in NVIDIA actually be fundamental at this point or no?
It may be. I mean, we haven't had an official statement from the company to verify that, but that's certainly something that could impact their numbers.
Melissa, let's just kind of look in the rearview mirror just a little bit here. Some of the recent earnings we've had out of some of the tech folks. Apple generally in line. Microsoft, Amazon, Alphabet, Netflix. I don't know. I mean, I guess a smidge disappointing, a little bit. What do you make of the earnings of these big tech names?
It goes back to expectations. Coming into the quarter, expectations were high about both what the companies were going to deliver and what the outlooks were going to be like. So companies, in order to generate an additional leg of alpha to justify the valuations and what's actually priced into the stock, companies needed to exceed that. And if they're not, then it's disappointing to the market. It's disappointing to investors, and they will look for opportunities elsewhere where they can get a better valuation and more upside.
How do you think technology companies need to relay to the market their CapEx investment versus their profitability? Like Meta clearly did a good job of that. Like they showed that AI was helping to impact the amount of money they could make per ad that they sold. How do other companies that don't have that avenue deal with that?
Yeah, absolutely. This cash dimension to the mega caps is an absolutely critical one because we've been in an environment where rates have been rising. So if you're sitting on cash, your cash is getting a really nice return. So it gives companies a lot more freedom to invest it, and it makes that cash flow potential a lot stronger. And the mega cap tech companies have enormous cash positions. So now in an environment where that is potentially reversing, coupled with the fact that they're accelerating CapEx, it presents some interesting questions about what their cash flow positions are going to look like over the next 12 to 24 months.
So, Melissa, given some of the pullback we've seen in some of these tech names, what are some of the best opportunities in your coverage universe?
Overall, one of the things we're looking at really carefully is what is going to really trigger broad adoption of generative AI. We know there's an AI revolution out there happening, but there needs to be a trigger point where these companies are either internally adopting generative AI in a way that's giving them a competitive advantage, or they're crafting and creating an application that is going to revolutionize the way users, enterprises interact and become more productive. So that is really the critical nexus point, I think, where we're looking at what companies are actually going to be doing that. And that's really, I think, where we are with the generative AI revolution right now, and where mega cap and just tech stocks in general really are going into the second half of the year and next year.
So anecdotally, let me tell you the story. So yesterday, my best friend's moving to Costa Rica with her family for a year. So there's like a going away party, yada, yada. One of my friends is a consultant. One of my other friends also is deeply involved in the market. And guess what the conversation was between the two of them?
AI.
Yes. How much AWS comprises their budget and how much that's going to continue to grow with AI, and doubt that they're really going to see the benefit of that kind of money. And I'm wondering then at what point do customers, like one of my friends, pushes back and says, you know what, Amazon Web Service, I'm not going to pay you that money. I don't want to do that. I don't see the benefit to AI in that sense.
That's $1 million question. I mean, Amazon was an interesting one this quarter because their AWS business was very robust. It basically carried the whole company. It beat the quarter and it had a strong outlook. Their margin beat by over 300 basis points. There was an adjustment in there of 200 basis points, but still it came in over 35%. But when we look at the other side of the Amazon story on the North America retail margin, that came in soft. That business coming into the quarter was expected to generate a 5.9% margin, but it came in at 5.7%. And the company said, well, as we look out at our guidance, we, kind of don't really see the profitability coming in that strong. And it actually came in below where the consensus was. Consensus was about $15.7 billion in operating profit, and the top of their range was around $15 billion. So it was like, whoa, wait a second.
Right.
You've got AWS doing really well, but what else is in there that's potentially diluting it? Or is AWS, to your point, potentially slowing down a little bit, or we're not seeing the profitability that we have been seeing?
All right, Melissa, a lot to think about here in the big tech space. Melissa Otto, head of TMT Research, S&P Global Visible Alpha. We need some perspective on this market in a big way with some of those futures readings that Lisa was just reporting. And for that, we go to the lawn in Charlottesville, Virginia. Lori Calvasina, head of U.S. Equity Strategy, RBC Capital Markets. If you know what that means, you know. Lori, what do you make of the last couple of trading days here in the futures market here today? The market kind of turned on a dime there on that jobs number.
It did. Look, I think the biggest takeaway we have right now is people like Tom Keene going on vacation. I think everyone's going to be afraid to take vacation in August now. But I think the reality is that we have to take the last couple days in context. And that's what we really tried to remind people of in our weekly this morning. We're not sitting here saying recession fears didn't escalate, that there weren't some signals in the jobs report and the ISM report on Thursday. But we do think people need to bear in mind that we had, I think I came up with like 6 or 7 different reasons that markets should be selling off right now. This includes valuations that were full, a tendency for the stock market to sell off after first rate cuts occur. So maybe we're pulling that forward. We had extremely elevated positioning on the CFTC data for U.S. equity futures, NASDAQ futures, S&P futures. AAII was sending us a sell signal the last couple of weeks. We've got the election where dynamics are shifting that typically produces a pullback in September. Again, maybe we're pulling that up. And by the way, markets have been correlated with Trump, and now he's lagging behind Harris. So there's a lot of stuff going on. And by the way, add the fact that seasonality the last 5 years has been really, really poor time to be in the stock market, August through October, I think, including specifically 2022 and 2023. So there have been a lot of reasons this market has needed to take a bit of a pullback in here.
So, Lori, it's Alix, and I love reading all your notes. It's like first must read on Monday, got to set you up, right? When does, though, a healthy correction become an unhealthy one?
So I think the biggest thing I'm worried about in here, and I'm trying to tell everybody, keep a calm head today. I do think we need to dig into the BLS report a bit more, find out exactly what the weather impact was there. But I do think that the rule of thumb I always use is 5 to 10% is a typical correction if you look from peak. So that would kind of take us down to sort of the 5,100 marks. We'd have to watch markets closely in here. If you look at sort of the 10 to 20% range, that's typically, in the post-GFC world where the growth scares settle in. Now, 2022 was a little bit different. It wasn't a recession. We fell 25%. But generally, anything more than 20% is an actual recession. And I think one of the reasons why it's so jarring, kind of the move from Wednesday to Thursday, Friday, is that if you go back to corporate earnings and equity investors, we've all had our heads stuck in these corporate reports the last couple of weeks. What we're seeing in that jobs data, it's not really syncing up with what we're hearing from companies right now. So I do think we need to sort of take it one step at a time in here.
Lori, what do you think the Federal Reserve is going to do here? There was some discussion over the weekend, maybe an emergency rate cut. What do you think they're going to do here?
So I have no idea. I think we have to talk to the rates crowd. We have to talk to some of the reporters. But the truth is, I don't. And I get a little bit frustrated with the Fed guessing game that people play on Wall Street all the time. I think they're looking at data. They're trying to make the best decisions that they can. But what I can tell you is this question has come up a few times since Friday, and even frankly since the CPI report. That's when my rate strategist was telling me he was first getting questions about 50 basis points. And I kind of went and dug up some of my work from SVB, looked through some of my files, and we found that in at least kind of my time on Wall Street, I started in 2000, when you either get sort of the big chunky cuts or you get the emergency cuts, generally they don't tend to happen in isolation. They tend to happen in bunches. So I worry a little bit that if we get some sort of emergency action, if we get some sort of big chunky cut, it could further spook the market. That's just my opinion, though. There are certainly people out there smarter on this than me.
No, I mean, it's a fair point. And there are a lot of people out there who trade equities who are in kind of your boat, right? So based on all of that, when and where do you buy the dip?
So I think we've got to take it one day at a time. I want to see sort of how the market reacts if we get down to that 10% threshold. I think that's sort of where we could look to see if there's a line in the sand. The other thing that's come up a bit this morning is just, sort of looking at valuations. We've been very elevated, for example, on those top 10 names in the broader market. In the S&P, you've been trading, you got up to 32 times on median PE, actually. It's now fallen down as of last Wednesday to around 27. Who knows where it is today? We'll see tomorrow. But I do think you want to sort of watch for some additional relief on those valuations. And I've noticed just in my career, a lot of times you don't have to get super cheap on things for the bleeding to stop. Sometimes you just need to go get back to average, get a little bit below average. Small caps, for example, is the opposite phenomenon right now. They keep getting up to average and then the trade sort of peters out. So I think watching when we get back to average valuations on certain things is going to be critical.
So, Lori, I'm just looking at NVIDIA here in pre-market trading. The levels suggest a 30% pullback from its recent high.
Wow.
I mean, that gets your attention. I mean, if you told somebody you could buy, I'll give you NVIDIA at a 30% discount to its high, if you said that to them on Thursday, I think they'd grab it both hands. What do you think about some of these big tech names that have led the market higher and which are now taking the big brunt?
So when I think about the basket as a whole, I think that we've sort of hit a valuation ceiling. I mentioned, we kind of got up to 32 times on those top 10 names on a median PE. When it's hit sort of, the upper 20s, 30 in the past, that's really been the ceiling. So I think we kind of hit the ceiling on valuations. If you look at the growth rates on the Mag 7 versus the rest of the market, we've had a decelerating growth advantage. And so, those Mag 7 names had just ferocious earnings growth last year, but it's expected to decelerate both this year and next. It's hard to sustain the premium valuations when you've got a growth rate that's accelerating off peak, even if everything is fine. Mm-hmm. So I do think the valuations are really the key to the story here. We just need to see some additional relief.
The VIX has jumped an insane amount in 2 days. The curve is super inverted at this point. What kind of damage does a VIX that's moved the most in 30 years do to the equity market?
So look, I think it's a question of where does it settle out? I actually called someone this morning. I got to the office pretty early and it was around 50 and I called someone to say, is this real? Is this actually the real data point? So I'm glad you guys are reporting it as well. But I think the reality is it just tells me that we have a sentiment problem in the market. That sentiment needs to unwind. I mean, if you look at the CFTC data, Alix, the broader U.S. equity futures positioning across all of the buy side, so we add up 3 different categories together, it's been sitting above January 2018 levels. It's been sitting above February 2020 levels and also above the levels of 2021, 2022, though frankly, those weren't nearly as high as what we saw back in the 2018 and 2020 timeframe. So there has just been, I don't think people necessarily have sounded rah-rah when you've talked to them, but if you've looked at the actual positioning data in the futures market, these are some of the levels that have historically just caused a tremendous amount of volatility, and we need to let that play out in here.
All right, Lori Calvasina, thank you so much for joining us. We know you're super busy today. Lori Calvasina, she's head of U.S. Equity Strategy at RBC Capital Markets. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, geopolitics, finance, and investment. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show. Weekday mornings from 7 to 10 Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And as always, on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.